Spartans! What is your profession? Spartans! What is your profession?
Howdy folks, Mark here with Flipside Trading. Today what we're doing is to give you an overview of options, not going in depth, not trying to make you an options trader. I want to provide you some context so you can follow the notifications, understand what we're trying to achieve, and execute the trades at home if you decide to in order to generate income in your own accounts. So let's dive in and talk about what we're going to cover today. So the first thing is why options? Why trade options versus just buying stocks or mutual funds? Let's understand the terms and definitions so we have a great communication piece, and also what drives the price of an option such that we can be profitable. We'll take a look at some simple trades, right? Some directional trades, long calls and long puts. Okay, these are similar to buying stock, but they provide some advantages such as leverage, which we'll talk about in a moment. And we'll take all that, we'll put it together, and we'll talk about some of the key takeaways and a summary position. All right, the first thing we want to start with is why options. Well, as you know, we've been in a bullish market for the last 9 years, and the market's been moving at an exponential rate in the bullish direction. Now, a lot of those stocks that are moving and driving the market, such as Google and Amazon, are trading at $1,100 to $1,500 a piece. Well, you can't buy very many shares at $1,500 a piece, as in the case with Amazon. So options allow you then to leverage your trading capital, so you can participate with some of these high-priced stocks in a very risk-defined fashion. By doing that and having that leverage, the options can then generate a return on investment, i.e. an ROI, much greater than if you own the equity itself. In addition, besides straight directional trading, by combining the options instruments and creating different strategies, we can create what's known as a spread trade. That spread trade means that it gives us the advantage so we don't have to be exactly right on timing and exactly right on direction. The stock can move a little bit against us, it can take longer to do that, and those things will benefit on our side. The key thing here is that it drastically increases the probability of success. So we're going to use those combination of directional to create wealth and the spreads to generate income. All right, so let's talk. What is an option? An option is a contract between two parties. That's you, the trader, and the market. Whatever brokerage you're using, there's known as a market maker, and they keep the market going by buying and selling whatever you want to do. They take the other side of that trade. Now, options were first initiated to help really, buy or sell and change equity ownership. But that's not what they're used for mostly today, especially in the retail side. They're used either for more hedges, or mostly they're used for the change in the value of the option itself. Now, the best way to think of an option is to think of something more tangible in your everyday life, such as a coupon, right? Think of the coupon as an option contract. So your supermarket, right? Think of them as the market maker, your brokerage. They sell you, right, a coupon that allows you to buy chicken for $2.50 a pound. And that coupon has an expiration date, right? 30 days. You've seen that for chicken, you see it for pizza, everything you get, in the mail, flyers, Dick's Sporting Goods, whatever. Now, let's assume that there's a drought, a bunch of chickens die off, chickens have a shortage, so supply and demand, and now the price of chicken rises from $2.50 a pound to $3.50 per pound within 15 days. So happening after 15 days, we're still within the valid coupon application date. Now your coupon becomes more valuable because now you can sell it for $3.50 because that's what the price of chicken is. So basically, your coupon has increased $1, right, from $2.50 to $3.50, and that would allow you to book a profit of 40% return, right? That's what we talked about before. We're looking to actually trade the change in the value of the option versus trying to actually, use it to affect equity ownership in one way. Now, let's assume that didn't happen, right? We didn't have the drought, and the price of chicken remains the same. And it's at or below $2.50 for the next 30 days. So there's no reason to exercise that option, is there? There's no reason to buy chickens with that coupon, right? Especially if it's a $2.40 pound, why use the coupon? You'd rather go buy it at $2.40 instead of buying it at $2.50. So what happens is that coupon, or in this case the option, it would expire worthless. Well, the great thing is that you can sell your coupon, your option anytime. You don't have to wait until it's worthless. So if you see that the price of chicken is going from $2.50 and it drops to $2.40, at day 10, and then at day 15 it drops to $2.30, well, you can sell it for $2.30 and go ahead and cut your losses. You don't have to wait for it to go to zero. Okay, so let's take a look at the different option types that there are, right? What are these instruments? An option, as we talked about before, is a contract. So therefore, you need both a buyer and a seller. Now, if you're a buyer of an option, you are considered long. And if you sell that option, you are considered to be short. As we talked about, right, this is the leverage piece, that each contract controls 100 shares of the underlying instrument. When I mean underlying instrument, I mean stocks such as Amazon, or an ETF such as the SPY, which is the index of the S&P 500. Right? So basically there are two types of options. First of all, we have the call. Now, if we buy that option, right, we're going to buy it to open. We're going to open the trade by buying it, just like you would buy general stock. And the assumption is that the underlying stock price is going to increase. So then you would be long, right? You're long on a bullish position to increase that option price. Now, to close the trade, you have to sell it to close, right? You bought it to open, you have to sell it to close. The other type of option is a put. Again, you can buy it to open. You buy it to open, you are long that position. But what's key here, even though we say long, we want the underlying stock to decrease, okay? Then, of course, to get out, since you bought it to open, you have to go ahead and sell it to close. So let's take a look down here at the, right here. So let's think about that, right? If we're calls and we have a stock that's at $50, right? We're going to buy that call to open. We want the stock then to increase, move this way, and we get to a target that we think is the right time to take profits. We're going to go ahead and we're going to sell it to close. Conversely, right? Stock's at 50. We see the economy's tanking a little bit. We feel this stock is going to go ahead and decrease in price. We're going to buy a put option to open. We're going to want that price to decrease. We're going to want the price to go this way. When it hits the profit target, say at 40, right? So it drops from 50 to 40. We're going to want to sell that to close, okay? So let's have a little exercise in logic here and see how close you guys have been paying attention. If we buy a call to open and want that to be bullish, if we sell a call to open, would that be bullish or bearish? Right? That's going to be bearish, right? We're selling the call to open, right? Just like we talked about up here, a seller of options is actually short. So we want that, right? Calls, we want the price to increase. So if we take the inverse of that, we sell that call, we want that to decrease. So if we sell it to open, we have to buy it to close or sell it to close. Remember, it's a contract, so we have to do the opposite. So we would sell it to close. Right? Having that basic concepts down, understanding long and short of the two options, right? Call option, we buy it, it's bullish. We're going to buy it to open, want the price to increase, we're going to sell it to close. Puts, if we think that we're going to see the price decrease, we're going to buy it to open, we're going to wait for the price to decrease, we're going to sell it to close. Now, if it goes against us, we're also going to sell it to close. But that's the way it works, right? Nice and easy. Okay, so now we understand the option types between puts and calls. Let's take a look at some of the advantages of options. Okay, let's assume that we just have a $10,000 account and you want to buy a stock and you're going to purchase 100 shares at $50 a share. So that's going to cost you $5,000. So that risk that you have is basically $5,000, right? So if that company, XYZ, went bankrupt, so then the stock price went from 50 to 0, you would lose that $5,000. Now the key thing here is that, to participate, even with a stock at a low price of $50 a share, and you only have a $10,000 account, you're going to put 50% of your account in one trade, i.e. that $5,000 represents half of your total account value. So you have a lot of risk in that one trade, and you have to hope it goes in your direction. Now let's assume the positive here, and let's assume that the stock moves from $50 to $52. So that gives you a profit of $2 a share, and right, for our total profit of $200. Now that ROI is basically 4%. And the reason it's 4% because you had such a large capital outlay, and you made very little based on that $200. Now let's take a look here on the other side. What happens if you buy options, right, on a stock? Well, if you purchase one call option at a contract at $4 a share, so that contract controls 100 shares, so the cost, right, the actual cost of your investment is $400. Therefore, your risk is what you put out there. So if that stock goes from 50 to 0, you would lose the overall debit that you paid. That would be the $400. That's your risk, very, very well defined. The key thing is to participate on that is that you're only using 4% of your account value, right? You're only putting $400 to work out of that $10,000. So now you can diversify and or actually have a larger position without being so overweight that if this trade goes against you, it just takes your whole portfolio down and blows up your portfolio. So let's take a look what happens, right? The same type of, corresponding, price increase from a positive situation. If the option value increases just $1 from $4 to $5, that profit's $1 a share for a total of $100. Right? Now your ROI is 25%, right? You only risked $400 to make one. That's the leverage of options. That's what's important so you can participate in the market. So in summary, the key thing is when we buy options, your risk is defined, right? It's the cost of the investment. Very straightforward. So you don't have to worry about all these strange stories that options are so risky, you don't know what's going to happen, and you're going to end up in the poorhouse. You know what your risk is before you start, just like when you buy stocks. Now, when buying stock and controlling 100 shares, right, it's the same as 100 shares for 400, right? You get that leverage piece. Now, the key thing is that leverage cuts both ways. So if the stock moves against you, you will incur a greater loss than if owning stock, right? That's the whole risk piece. And that's why we talk about wealth creation versus income creation, high probability that we're going to do much more of this income versus this wealth, so less of this directional type of trading. But I want you to understand what leverage is and then how it works in your advantage. Let's go on to the next piece. So what drives the price of an option? Remember, we want to benefit of the change of value of the option. Well, the first thing is price of the underlying equity or ETF that we buy. As you can see here, if you buy a contract at $2 a share, it's $200 a contract, right? We talked about your max risk is the debit. And as this stock, continues and begins to, move up in this direction, the stock price moves this way, right? Goes higher above 50. The value of the option continues to grow higher. Now, theoretically, it can be unlimited, right? If a stock's at $50, it can go to, a million / infinity. Not very unlikely, but you get the general idea. Conversely, right? If we buy a put, right? Buy it to open, we're then expecting that the price of the underlying goes down, and that will then generate the option price moving up. So again, if we buy the contract at $2 a share, right? So it's $200 per contract. That's our overall risk. That's the debit we put in. And your max profit is set when the stock goes to 0, right? It can't go below 0. It can only go to nothing. So in that sense, your profit is somewhat limited. But the key here is that when you buy a long call, you want the price to increase. When you buy a long put, you want the price to decrease. Okay? All right. So now let's take a look at the other key driver of option pricing, and that's what's known as implied volatility. So implied volatility is just a fancy name for the level of fear and uncertainty in the market and or a general instrument around that event. So what does that mean? So the general market, if we have all these unstable political conditions, the Brexit, the budget deficit, making sure that we don't go bankrupt and extending the overall spending limits that we have, North Korea, natural disasters. These things are general market conditions that affect all stocks. And the more uncertainty there is, then the higher the implied volatility. The more implied volatility there is, the higher the option price will be. So if you buy at a point with low volatility and all of a sudden one of these events occurs and you have high volatility, well, your option price will definitely increase. And that's the case if you're buying an option, you're long an option, you want that option price to increase so you can take advantage of that. But also there are known events right around not only certain underlying but the market. So around a stock like Tesla, for example, earnings are key, right? No one knows what's going to happen. How much money did Elon Musk sell? How many cars did he generate? How much money did he lose, right? No one knows until that announcement comes out. So leading up to that date, right? Let's assume it's at April 20th. Then for Tesla to report their earnings, that market uncertainty between April 1st and April 20th, you're going to see the implied volatility start to increase every day. And the general side, there's also economic reports such as gross domestic product and the employment, which come out on regularly notified basis and a regular time date. So you can see as those dates approach, again, volatility will increase. So again, the more uncertainty, the higher the implied volatility, the higher the options price. So we just talked about that earnings piece, right? A lot of times it's good to buy calls on stock, and we can make that and watch hopefully the price will increase along with the volatility, and therefore you get a double leverage and therefore a very, very profitable trade. And we'll do some of that, and you'll see that as the notifications come out. So that key takeaway, right? You want to buy options in periods of low volatility if you're buying options, and you want that volatility to increase in the future. You do not want to buy at the high point of volatility, because once the news comes out, once Tesla reports their earnings, there's no more uncertainty. So what happens? That volatility goes back to its norm. When that volatility goes back to its norm, that's going to decrease the price of the options. So we're going to take that into account too as we look at these different earning events and different uncertainties, right, as we go forward, to take advantage of implied volatility to help us be more profitable in our option strategy and selection. The other piece we talked about is on option price drivers is time, right? All options we talked about have an expiration date. You get to choose what that expiration date is to a certain extent. And when they expire, options expire worthless. So therefore, when you buy an option, it's a depreciating asset. So time is working against the buyer. So every single day it loses a little bit of its value. Now you can see here that when you buy options, right, with like 120 days, from point A. So if it's January 1st and you buy an option with an expiration of March 31st, that's a 90 days of expiration. You can see that during that time period, right, that first 30 days, you don't lose very much money, right, through the overall depreciation. But that depreciation starts to increase every 30-day period until you get to the last 30 days. You can see that it exponentially moves down. So when we buy an option, we definitely want to buy it more or less, kind of at least in here, such that we're not fighting this depreciation, okay? Now, when we sell an option, we do want things to go to zero. So we're going to go ahead and definitely, sell those options in most cases, in this time frame with less than 30 days to take advantage of that. So again, time works against the buyer because it loses value incrementally. We want to buy options with enough time such that it doesn't erode our chance at profits and erode the option price itself. At the same time, if we're going to sell the option, time works in our favor. So When we have time working with implied volatility, working with price, right? In the case if we buy a put option, if the stock decreases in price and it moves down as we expect, and we have the decay that happens every single day, and implied volatility increases because people are getting nervous because the stock is dropping, well, you know what? We can hit our profit target much sooner. So those are really the three drivers of option pricing. There are others, but those are the main ones that we really need to be concerned about. So let's go ahead and take a look at the trades themselves, right? One more time. So we want to be bullish, okay? We're going to go ahead and we're going to buy a long call. We want that stock price to increase, okay? That debit that we use is going to go ahead and be our maximum risk, okay? So when we buy that call, we're going to buy it near that current stock price. So it's at 50. We may buy it at 48 or 47. And we'll buy it, for $4 a share. That max profit we talk about is theoretically unlimited. We're going to buy it to open. We're going to sell it to close, hopefully for a profit. That advantage is that we have a leveraged directional play with our risk defined, the cost of the trade. Now the disadvantage is we need to be right in both timing and direction, right? We know when we buy a call, we want it to be bullish. Now we know that if we buy it within 30 days, it has to move in a bullish direction within 30 days. If it does not, if it trades sideways or trades down, that option will lose money, right? And that's not what we can do as part of the overall trade. Now conversely, right, directional trade, right, the long put, we're bearish. We want the price of the underlying to decrease. Again, we're buying the option. That's a debit. Our risk is then defined as the overall cost of the trade. So again, if we have a stock at 50 and we're wanting it to move down, we're going to buy those puts to open. We're going to wait until that stock moves in our direction. We're going to sell that to close. Okay? Now, again, the same thing. Since we're directional, we have a leveraged directional play. The risk is cost of the trade. Again, our disadvantage, because we are purely directional, we need to be right on both timing and direction. So, here are the key takeaways, right? An options contract requires a buyer and a seller. You as a retail trader can either be a buyer or a seller. So, little pop quiz. If you buy a call, are you bullish or bearish? If you buy a call, you're bullish. If you buy a put, are you bullish or bearish? If you buy a put, you want the stock to decrease, so you're definitely bearish, right? So when you buy it open, you need to sell to close. Now, a position can be made of just simple calls or just puts or a combination of both, okay? There are lots of ways to do that. We're going to keep it very simple, but just know that we have a combination of calls and puts to put these strategies together. Remember, the key advantage associated with options is leverage. Each contract, right, controls 100 shares. That allows you to participate in the high market movers such as Amazon, Google, Netflix, etc. Our risk is defined when we purchase the options. It is the cost of the trade. We are always going to have defined risk in every single one of our trades. We are never going to go in the direction where we have undefined risk, okay? So it'll be very safe in what we do. And lastly, options pricing, right? Three main factors that affect options pricing. The overall direction of the underlying, right? For purchasing calls, we want to be bullish. We want the stock price to move up. For purchasing puts and bearish, we want the price to move down. Implied volatility. That's just the relative value of the overall level of uncertainty, right? The more uncertainty is, the larger the move that there can be with the option, so therefore the more expensive the options is going to be. And remember, when you buy an option, or any option, it's a depreciating asset. All options are worthless at expiration. So we need to buy an option with enough time value on it such that we do not get whacked by that depreciation effect. However, when we sell an option, we do want them to expire worthless. and that'll be a good thing for us. So that's it. That's part one. If you guys have any questions, give me a call. We'll walk you through it. We'll make sure you understand what's happening. I'm more than happy to help. Just give me a shout. Okay, digest this, and then when you're ready, let's move on to part two. Thanks, guys.